Hello and welcome to NuView's workshop at 1. My name is Steve Mello, and I'm so excited to be here talking to you today about the health of rental market. Just a quick before we get started, NuView is a IRA custodian. That means not registered investment advisors or tax professionals. If you are looking for advice in those areas, please seek out those entities. NuView custodies IRAs, ESAs, HSAs, and 401ks for the purpose of making alternative asset investments. Self-directed IRAs are not a new concept. That's been around since the creation of investable wealth or uninvested, simply because people are familiar with the owner's ability to invest their IRA themselves. The IRS does require that you have a custodian to hold the IRA and make transactions on your behalf, and that view comes in. There are several advantages to investing through a NuView IRA or a self-directed IRA. The first is diversification. So investing in a self-directed IRA allows you to get your money out of the stock market and into alternative investments. And we'll talk about what those are here in just a second. Furthermore, the tax savings and advantages that come along with some of the different account types that we offer and are what attract most of our investors, being able to invest on a tax-free and tax-deferred basis. And then lastly, investing in what you know. So the alternative asset space allows you to invest in almost thousands of opportunities and really hone in on something that you're interested in and what you know. You can invest in tangible assets, brick and mortar, places where you're familiar with. You can walk in, check the status, and for that, it attracts many investors. As mentioned, NuView is a passive IRA custodian. We do custody a number of accounts here at NuView. The most common are the traditional and Roth IRA, with the most common. Most people have already been contributing to an employee-sponsored plan, like a 401k, and that money can be rolled over into a traditional IRA. And for that reason, traditional IRA is the most common account that we custody here at NuView. The contributions to the traditional IRA are pre-taxed, and you can make an annual contribution of $6,000 a year and up to $1,000 a year additional catch-up contribution after the age of 50. The Roth IRA, the contributions going into those are post-tax. You can still make the same contribution, $6,000 a year with a $1,000 catch-up contribution. But as I mentioned, unlike the traditional IRA, the contributions on the Roth IRA are paid on, the taxes paid on the contributions going in. Moving on to the employer plan. So NuView custodies a number of employer plans, the solo QRP or 401k being the most popular of these three. The solo QRP is meant for the small business owners with no common law employees. And the main advantage here is that it allows you to make much higher contribution limits, up to $61,000 a year. With this type of plan, you are able to make contributions on both the employee and employer level. So you're able to make up to $20,500 a year contribution on the employee level. And then you are able to match up to 20 to 25% of your gross annual income on the employer side. There is an additional $6,500 catch-up contribution for the solo 401k after the age of 50. There are some other advantages to the solo QRP. If you are an investor that invests heavily into debt leveraged property or real estate, there is a tax known as UDFI, that is the unrelated debt finance income tax. And when investing through a self-directed IRA, this is a tax that you would be responsible for on some real estate transactions. Solo QRP investors are not responsible for that tax when investing in debt leveraged property, and that's a huge advantage for some. In addition to that, you are able to take a loan from your solo QRP or 401k up to $50,000 or not to exceed 50% of the total account value. So that definitely depends on the income of the business, how much you're contributing to the solo 401k. And then the only caveat with that is that you do have to pay that loan back with interest. But in this case, you are the beneficiary of that account. So you would be paying back yourself. The SEP IRA is another employer plan. This is a pension plan for employers who are looking to make contributions to their employees' retirement. Like the solo, you are able to make a high contribution limit up to $61,000 a year. The only caveat here is that whatever contribution you make for yourself, you must also make for your employees. So if you make a 10% contribution for yourself, you must also make a 10% contribution for your employees as well. And that, of course, is based on your annual salary, your employee's annual salary. The Simple IRA is another employee-sponsored plan, and this is for self-employed individuals that do have employees. And this is to help just establish a beginning starter retirement account for those employees. The contributions are much lower than that of a SEP. So for that reason, the SEP is a little bit more popular than that of the Simple. You can make up to $14,000 a year worth of contributions to the Simple with a $3,000 a year catch-up contribution after the age of 50. The specialty plans that I mentioned earlier, like the ESA and HSA, the Education Savings Account is a plan. If you have grandchildren or children that are looking to save for college, this is a great plan for you. You can contribute up to $2,000 to this plan. The account is not tax deductible, but it is tax-free on any money coming out as long as it's for related educational expenses. So that can be textbooks, clothing, technology, so laptops if it's necessary for class, but it does have to be a qualified education expense. And like I said, you can make up to $2,000 a year worth of contributions for that account, and they have to be made by the beneficiary's 18th birthday. Following the ESA is the HSA, that's the Health Savings Account. And with this account, it's kind of the best of both worlds. This account is tax deductible and tax-free on the money coming out as long as it's used for qualified health expenses. If you're contributing for yourself only, you can make a contribution of $3,650 a year. And if you're contributing for your family, then $7,300 with an additional $1,000 catch-up contribution after the age of 55. And similar to the Education Savings Account, these are for qualified expenses, so health expenses, but it's meant really to prepare you for life's unexpected circumstances. These are great plans to pair with any of the plans that we have above. So the traditional Roth IRAs, solo QRPs, etc. This just allows you another vehicle for investments and is great to pair with any of the additional plans above. So by now you're probably asking yourself, Steve, what are alternative assets? What can I use my self-directed IRA to invest in? Well, it's really anything the IRS doesn't prohibit, which is thousands of things. There are a bunch of exciting opportunities available to our investors, some of which are listed here. We do see a lot of private entity investments, so LLCs, general partnerships, etc. We have a lot of people investing in real estate, so foreclosures, tax liens, convertible notes. Then we have crypto. So we've seen a lot of crypto investors, Bitcoin, Ethereum, Litecoin, and then promissory notes, both unsecured and secured. And without further ado, I'd like to introduce Rich Munroe. He's been investing in properties for over 15 years now and has been is a Airbnb superhost and has been very successful with the short-term rental market. He is here today to talk to us about the health of that market and give us a quick update. So, you.
Yeah, thank you so much, Steve. Thanks for inviting me to the workshop today. I'm very excited to talk about the sharing economy and some of the things that we are experiencing right now in the short-term rental market, kind of provide an update for everybody.
Rich, we're unable to see your screen.
Let's give it a second here. All right, should be coming in now.
Okay, if you could put it in presenter mode.
Yep. All right. All right, well, thanks again, everybody. Just to kind of give you guys a brief introduction, my wife and I have been real estate investors for over 15 years now, and we're also investors with self-directed IRAs. We had our self-directed IRA that was done to do tax lien investing, and so that's kind of what got us into real estate. And we acquired about 350 tax lien properties, mostly in Georgia and in Maryland, and they have similar redemption rules. And so we were able to, get started with our self-directed Roth IRA. We purchased about 7 or 8 tax liens and tax deeds and kind of proved out the process. And then we grew from that experience, did a bigger line of 10 to 15 million to actually go out and aggressively purchase tax liens. So we kind of saw the worst case scenario of properties and learned the real estate business from that process. And unfortunately, in most cases, those properties have been, pretty much vacant for several years. And so it's kind of the worst case scenario, full gut rehabs. Most of those properties we sold to other investors and let them fix them up and sell them on a retail kind of a fix and flip model. And then in 2012, we started our own fix and flip strategy with properties in Georgia and Illinois, and we're able to kind of build a profitable fix and flip business. And like most real estate investors, we started looking at, the long-term retirement passive income strategy as far as, wanting to be able to develop that over a longer period of time and to create passive income. And so we created a traditional rental portfolio, long-term rentals, and we were kind of on our way to get a pretty good number of properties. You're told to set up a passive income rental property portfolio. You're doing great as an investor if you're clearing $400 to $500 per month after your debt service. And so you got to imagine you got to build up a pretty large inventory of properties to kind of get up to a meaningful number. And so we were on our way to get 8 or 9 rentals set up, and we got burnt out. We had evicting people right before the holidays, having to rehab the properties all over again once people have been in there for a year or two, and it basically, the numbers just didn't make a whole lot of sense for us. So we took a look at the short-term rental model right around 7 years ago. And for me, it was a light bulb moment. Basically, the properties are staying in much better shape. Even though you would acknowledge there's a higher volume of folks that are coming and going. We probably host on average 4 to 5 different families and groups of guests on a monthly basis. However, what's happening in between those guest stays is we're professionally cleaning and inspecting those properties such that we are able to make sure that when we took the listing pictures, if it was 6 months ago, when somebody books our property, it's got to look just like those listing pictures. And so you can basically blink your eyes with your property condition, and after a year or two, that property is going to be in great shape compared to a long-term traditional rental. And so that's kind of what drove us to going to that model. We basically stopped doing our fix and flip business unless we had short-term rentals as a part of the exit strategy. And we developed a portfolio of properties in Georgia and in Florida. We're in the Tampa Bay and Bradenton market down in Florida as well. So those properties we actually acquire through acquisitions, and we potentially can buy it as a distressed property, fix it up, and then put it on the market for short-term rentals. We also have a what's called a master lease or a rental arbitrage strategy that we employ with mostly our multi-family buildings, but we also have 3 and 4 and 5 bedroom homes that we do that with as well. And then we also manage for other investors. So we've kind of got a scalable operation. Currently we have about 75 properties that we are operating and managing, and obviously have been through the pandemic with the short-term rental market, and we'll talk about what we're seeing now since the pandemic as far as occupancy and average nightly rates. More recently, I am also an Airbnb ambassador and a community leader, so we are actually helping to train other Airbnb hosts to become have the ability to do short-term rentals, kind of get them off to a great start. We help them out with their listings in the beginning, and that's a new program that Airbnb has rolled out because, frankly, they are looking for more people to host properties. They have a shortage of properties that are needed in the marketplace based on the amount of demand that they're currently getting. Also, and this brings up a topic we're going to touch on towards the end of this presentation as well. The regulatory environment in Atlanta right now is pretty aggressive. There have been some new recent ordinances that have been very non-investor friendly, and so I formed a nonprofit earlier this year to kind of have a seat at the table to combat some of those restrictive ordinances. It's called the Atlanta Metro Short-Term Rental Alliance, and I'm the president. And so I'll go into some more detail around an update on what's going on across the country as well from a regulatory standpoint as it pertains to short-term rentals. Now, one of the things that I always kind of give kudos to, Airbnb is really kind of the leader, obviously, in the short-term rental space. The peer-to-peer ability of individual investors being able and individual consumers available to list their properties as a short-term rental and generate revenue. And what's really spawned this ability to do this anywhere, because we're in suburban markets, we're in urban markets, not just in vacation type settings, is the Airbnb model. They've set up this kind of community-based platform. Those of you that have traveled are familiar with it from the guest side of things. You have to basically provide a review of the host and of your stay, and then the host does the same of the guest. And so that kind of creates more of less of a hotel type experience, more of a local experience, and is really kind of the beginnings of that marketplace. It's looking to grow for another, by 2025, up to $335 billion. As most of you know, Airbnb has gone public a little over a year ago. Their revenue has jumped 58% year over year to around $2.1 billion, although their stock prices have gone down a little bit. But they are continuing to grow with additional bookings and additional occupancy and kind of continue to drive revenue. And so most of the folks that are doing short-term rentals as investors, like us, we list on multiple platforms. We're on Booking.com, Expedia, VRBO. We're also an approved Marriott Homes and Villas property listing as well. But no matter what you do as a host in this business, Airbnb is going to typically generate 70% or more of your revenue every month. And so that's why we tend to pay close attention to kind of what's going on in the Airbnb world. And with that, Brian Chesky, the CEO, earlier this summer released a kind of a new format on the Airbnb platform, which is a concept that of their belief that a lot of folks, obviously since COVID, are working remotely now, and they have the ability and the flexibility to do more traveling and moving around. And it's not so much about where you're going with a fixed period of time, but they've adjusted their platform to give you the flexibility where you can basically search based on different types of categories of properties. And you still have the ability to do it the old-fashioned way. You have to kind of put in the date and the specific city that you want to go to. But they've come up with this concept of folks are less interested now on where the location is and more interested about the experience and kind of what the amenities are. And so this is something that they've kind of started, and it caused a little bit of a ruckus, I believe, in the hosting community, because when they added these new categories to the Airbnb platform, it basically reset their searching algorithms. And so for Airbnb's platform, your listing basically gets a criteria based on activity on your listing, based on how many reviews you have, how many positive reviews you have. And so your listing will appear on the first or second page if you're in good standings with some of those issues. And so when they did the changing to the categories, they kind of reset that algorithm. And so a lot of hosts didn't have their listings as visible as before. And it kind of impacted some of us with lower occupancy during that time period. Needless to say, again, it's good to know and understand the concept of this and kind of what they're doing. And just to hear some examples, right? So you've got a lake experience or different lake properties that you can choose from if you're traveling and that's what you're interested in doing. Tiny homes is a popular category as well. There's been some changes in a lot of the regulatory in a lot of major cities that are allowing accessory dwelling units or tiny homes to be put in your backyard. And so this is a popular way for folks that are either downsizing or want to supplement their income and throw one of these in the backyard and start renting them out. And as you can see, even though they're small homes, they're commanding a pretty high nightly rate, $150 to $200 a night, depending on the location. There are treehouses. One of the consistently highly sought after properties that's a treehouse on the Airbnb platform globally is a treehouse that's actually located in East Lake, Atlanta. That's got kind of a whole experience with animals and llamas and such that they continually get the highest demand. And so for a small treehouse, they're able to command $350 a night as a nightly rate, and that particular one stays booked constantly. And so that if you do the math on that, you're $7,000-8,000 a month on a treehouse that was put in the backyard with not that large of an expense to set up. And then you can get more elaborate. Obviously, there's islands categories, castles, amazing pools, and so on. And so just wanted to kind of give you guys an update on what's going on with the Airbnb platform first before we talked about the market. And so as we dive into some of the historical performance, I just wanted to point out and just kind of let everyone know there are different property types that you can do this with. Our 75 properties that we have are a mixture of single-family residence, 3, 4, 5, and 6-bedroom homes, and then we also have apartments and condos that are a part of that mix. We do have a couple of properties with swimming pools and jacuzzis, and on the lake and on the mountain. We also have properties that are kind of in the specialty category where we've got a 15-acre horse farm in Gainesville, Georgia, that is a 5-bedroom house with a swimming pool that kind of overlooks the horses that are kind of frolicking on the farm. So it's always good when you're looking at an investment strategy to figure out how can you fit into that specialty category, because it's definitely going to generate some additional revenue for you. Like I mentioned earlier, there are different markets, and they're typically broken up into beach, mountain, urban, or suburban. And most folks that know about Airbnb or VRBO or vacation rentals don't really think about the urban or the suburban category. And so we've done very well with properties that are in the northern suburbs of Atlanta, for example, that are 4-bedroom homes in the $500,000 price point with a swimming pool in the backyard. And we've been able to drive up that nightly rate. The market rate for that kind of property is in the $300 per night range. But through our kind of pricing strategy and getting positive reviews consistently, we're able to drive up and maximize the revenue to where we can get between $1,000 and $1,200 a night on that type of a property. And so strategically, that's what we tend to do, is kind of look at those types of areas. It doesn't have to be on the beach, doesn't have to be in a main part of town, although we do have properties that are walkable to a lot of restaurants and areas and parks and such, which do well as well. But you can also do this with properties out in the suburbs, just to point that out. Now, obviously, short-term rentals have gotten quite a bit of exposure to the institutional investors. Sonder is a pretty large player that has basically gone out and done a lot of new construction with apartment buildings or acquiring old hotels and kind of switching them over to short-term rental buildings. And so they've done a recent merger with a lot of funding there. There's a couple of other folks that have been active in this space that have done, invested, several hundred million and are in different markets and are basically strategically kind of, driving volume, adding additional bookable units as a part of their strategy. And so this isn't just being done kind of by individual smaller investors, it's also being done by the larger players. Similar to investors back in 2008, after the recession, aggressively buying up properties to do long-term rentals, we have a similar dynamic occurring with investments that are specifically going out and buying a large number of homes specifically for the short-term rental model. And so that shouldn't surprise you, obviously, because as we've talked about with the math, you're basically 3 to 4 times the monthly revenue doing short-term rentals compared to a long-term rental. And so for that same asset, these larger investors have recognized that value proposition and obviously the additional revenue that's generated. There's also short-term rental companies that are doing some of the kind of rental arbitrage master lease strategies where they're acquiring large number of multi-unit buildings. They may take a 50-unit building, basically 1 and 2 bedroom apartments, and they'll set that building up specifically just for short-term rentals and be a part of the investment strategy. And so that's another popular thing that's occurring. So let's kind of dig into some of the market activity that we've been seeing. And obviously with the pandemic during 2020, it did have an impact, of course, on the activity in the space, albeit it was a very short period of time, 30 to 60 days. We all experienced cancellations in that March 2020 timeframe when they shut down the international travel. Through 2020, although we had actually in 2020 and parts of 2021, our percentage of occupancy and our average nightly rates actually increased over the prior years. And so obviously, and that makes sense because we had a lot of travelers that were coming through that were cooped up during the lockdown and essentially wanted to get out and have a change of pace, and also with the ability to work remotely. And so we had a lot of those types of travelers that have come through. This is an interesting look at the demand change. And if you look, it's hard to tell, but if like the middle of that chart basically is at 0%. And so everything to the right-hand side is an increase percentage. Everything to the left-hand side of that middle portion is a decrease. And so this is basically looking at each market and showing the demand changes with the urban and suburban markets from 2022 compared to 2019, kind of pre-pandemic. And as you can tell, there's obviously some extreme flows in some of the marketplaces. Like I mentioned, we are in the Tampa, Florida market, for example. They've seen a huge demand change. A lot of our properties are not necessarily on the beach or on the coastal areas, but they are a 20 or 30-minute drive. And so travelers are okay with renting a 5-bedroom home instead of a hotel or a resort and driving 20 or 30 minutes to get to the beach. And so that's been a lot of the activity that's been occurring there. Atlanta market also showing a little bit of demand increase there as well. So this, again, we like to kind of keep an eye on what's going on in various marketplaces, various city locations to compare to how we're doing in our local markets. Now, so this dynamic is showing us the total number of short-term rental additions, since 2018, obviously through the pandemic. And as you can tell, there were a lot of listings that were taken down. A lot of the kind of the commercial corporate players that were doing the master lease strategy got hit in 2020, where they basically didn't have enough reserves to allow them to continue with having 2 or 3 months with no revenue. And so a lot of the listings that dropped off were that. A lot of them were still the mom and pop listings that were not able to basically conduct social distancing at the same time as having guests come into their home. And so a lot of those types of listings went away as well. But as you can tell, in early 2022, we are definitely back, and listings are continually increasing. We're kind of back above where we were pre-pandemic, and I would expect us to continue to grow there as far as the number of listings. So occupancy trends year over year. This chart is kind of looking at the difference between 2019, 2021, and 2022. And as you can tell, 2022 has shown some recent deductions in occupancy over the prior years. Like I mentioned, I think we kind of got a boost in 2020 and 2021 since the pandemic, and then it's kind of normalizing now. This is a similar look at that during the summer months, just to kind of demonstrate in more detail. That white line basically is the occupancy for 2022. And as you can tell, through September, August, September, July, August, September, which are really kind of the summer months that we usually get a large percentage of occupancy, is definitely dropping below where it historically has been. I think obviously a lot of the talk with the recession and gas prices and things like that have definitely impacted the occupancy decreasing. In the same vein, during that same time period, if we look at the average daily rate, it's quite the opposite. So that white line again is the 2022 activity. And we are, the good news is the occupancy might be going down, but our average daily rates are going up. As more and more people are learning and understanding about short-term rentals as being an option when they travel, it's becoming a more popular thing for folks to do over the hotel option. And so that's also allowing the pricing to increase somewhat. So we also kind of do a drill down as well on how we did over the holiday weekends. And so this is looking at the Labor Day weekend by market in terms of the adjustments of occupancy year over year. And so the green is, definitely in higher percentage occupancy than it was in the prior year, where as you get closer to the red color, it's kind of a decrease. And so Atlanta actually is a 14% deduction in occupancy, so is Seattle and Galveston, Texas. Now, ironically, and we're going to get into this in a little bit with regulations, Seattle has recently had very similar restrictions that Atlanta has had with non-investor friendly regulations. And so we're going to go over that here in a minute, but you can obviously see the impact it's had on occupancy with listings as well. So here's the same thing for the Labor Day weekend based on the average daily rates. Most markets have basically, like we've talked about, had increases in the daily rate, where Seattle is the only one that's taken a slight percentage deduct. Memorial Day, basically same kind of analysis. We're looking at the changes over the last several years, keeping each market and looking at what our changes are with occupancy and our average daily rate. And as you can tell, there's not a whole lot of variance in most markets. Same thing for the mountain markets. We do see some major changes there with occupancy, in particular with, like we've talked about, 2021 coming into 2022. Our beach markets are pretty consistent with occupancy. Average daily rates have been definitely going up. And then lastly, from a market analysis standpoint, it's good to kind of point out that the international travel, which used to be a big part of the vacation rental market, really is still just 44% of pre-pandemic level. And so I would anticipate as international travel picks up, we are definitely going to start to see, the more travelers coming internationally that are going to increase that occupancy level for us as that hopefully starts to open back up. So the regulatory environment, which is kind of the elephant in the room, for the most part of this presentation, I've talked about all the positives with short-term rentals, where basically this is kind of one of the major things you have to look out for is regulations. And so in most large major cities across the United States and frankly across the world, they've adopted these extreme requirements where you're either only able to do it in certain areas or you're only able to do short-term rentals if you are a primary resident of that home. And so typically that's the model legislation that Airbnb pushes. Airbnb started out as a home sharing company, and folks that are able to supplement their income to rent out a room in their home and things like that. And so rather than having or being faced with an outright ban by a local city or a county, Airbnb will push the primary resident requirement, which kind of limits, obviously, an investor to come in and be able to do multiple units. And so this is, like I've mentioned, what's recently occurred in Atlanta, where Seattle, Chicago, Washington, D.C., kind of all the major cities have already adopted this similar concept. We have no problem or no issue with being regulated and paying taxes and having rules in place, but what we have an issue with are basically the property rights taken away by not being able to do multiple properties and being required to be a primary resident, which is what Atlanta's done. We've been successful in having them delay their enforcement period through December of 2022. We're actually negotiating with the Mayor of Atlanta right now on legacy or grandfathering rights. And so as a starting point, and we've raised a legal fund with our members that are all very similar investors as we are. And we've basically threatened a lawsuit to file against the City of Atlanta in the event that we are not able to negotiate. Now, obviously, our preference is to be able to negotiate something with the city and avoid that from happening. And so, there's 7,000 listings in the City of Atlanta. And, these are some of the stats from the applications that have been made. There's only been a little over 1,000 applications made since March 1st, and there's only been about 415 licenses issued. And it's important to point out, in most markets like Atlanta, there's 40% of those 7,000 listings that are 2 or more listings, right? So, for example, we've got 32 listings in Atlanta that are impacted by this enforcement change or this ordinance change. And so there's a large number of listings that if we are not successful getting this resolved, could potentially go away and are going to require licensing and other things to be able to list their properties. And so we formed the Atlanta Short-Term Rental Alliance, and we, like I've mentioned, are actively lobbying and pursuing, negotiating with the city. If any of you guys are in Atlanta or would like to join our association to keep in touch with what's going on, that's our website there, amstra.org. And we are actually doing an in-person meeting in Atlanta in a few weeks to update our members on the current status of what's going on. Just some good news on the ordinance standpoint to kind of share with everybody. New Orleans has had a recent Fifth Circuit Court of Appeals that have basically made it unconstitutional for New Orleans to require folks to be primary residents to do short-term rentals. And so that's a recent ruling that's obviously in the favor of the short-term rental market. Similar thing occurred in Wilmington, North Carolina, fairly recently as well, where they have basically reversed the city of Wilmington's ability to license and require registration of short-term rental owners and operators. And so Wilmington's actually had to return a lot of the money that's been required to set that up. And again, one of the things we haven't touched on is the Condo or Homeowners Association. So in most cases, a lot of the properties that are located with homeowners associations or condo associations, they typically are going to restrict short-term rentals unless there's a majority of those units that are being done with vacation or short-term rentals in mind. And so across the United States, condo associations and homeowners associations can basically prevent you as a property owner from doing short-term rentals. In April, the Arizona Supreme Court issued a ruling that basically says that the associations within Arizona are prevented from or not able to make those types of exclusions or restrictions on your property. And so it's a good starting point in the state of Arizona. And so we're hoping to kind of keep an eye on that and see if we have some other states that take that up on as well. So with that being said, that's kind of the full presentation. I know, Steve, we had wanted to allocate some time for any questions, and not sure if we've had.
All right, sorry about that, technical difficulties. Yeah, so now we're going to open up the floor to any participants that have Q&As. You can submit your questions through the chat feature here on our webinar. Bear with me one second. Let me see if we have any questions. All right, so as those are coming through, Rich, I know, of course, you are based in Atlanta. You're heavily focused there in that market. You explained some of the reasons why you're there. Of course, many of the areas right now are pending legislation, and that will, be a huge factor in just seeing short-term rental properties. But what are some of the other questions you yourself when buying these properties, right? Do you want to bear what maintenance is required, et cetera? What are some of the questions that you ask yourself? What's the thought process?
Yeah, so that's a great question. After we qualified the fact that the regulatory environment does not restrict it, and we've also confirmed that we prefer typically as a rule of thumb to not acquire properties that have a condo or homeowners association unless it's already been pre-approved there. But we also look at the layout of properties, right? And so in a lot of cases, when you are looking to maximize revenue, the number of beds that you can get in a property is going to kind of increase that, right? So if you've got a 4-bedroom home that sleeps 8 people, maybe you can throw a sleeper sofa in the living room that's large enough and private enough that you can then now you can sleep 10 people with a queen size sleeper sofa. We try to make sure that when we're adding additional beds that it doesn't impose on the comfort or the ability to function, right? So we might have a large bedroom that we might put 2 queen beds in, but only if it's a large enough size room to accommodate that without it being cramped. And so that's one of the things we look at. One of the other things is, which again, with the Airbnb platform in mind, they have different categories that travelers and folks usually like to search off of. And one of those is kind of a workable office space, right? So from a staging and setup standpoint, it's $150 to get a nice desk and another $50 to get a chair. And if you don't necessarily have to have a private room to have the office in, if you've got a large bedroom or a large living room or a den area, as long as you allocate a spot for that, it's an important part as well strategically to make sure you're maximizing your views on your listing.
Fantastic. All right, and bear with me just one second. I'd like to see if we have any more Q&As that flowed in. Nothing that's trickled in yet. So as always, if you guys do have any question, Rich's info is below. Feel free to give him a call, contact him, and learn a little bit more. If you are interested in opening up an account with NuView, please email us at irs@nuviewtrust.com. And of course, find us on social media, Facebook, Instagram, and LinkedIn. Thank you as always for joining, and have a great day.